And on today's show, how lump sums and mortality credits can generate real returns. Part 4 of this week's series on secondary market annuities with secondary market annuity expert Brian Anderson from Annuity Straight Talk. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Innsmark. Let's get down to business. Well, welcome to day 4, Brian.
Thanks, Steve. Here we go again.
Well, here we are, and we're somewhat blowing the savant's mind here because we're introducing a whole new concept on annuities, secondary market annuities. If you've missed any of our shows up through this day's, which I think is Thursday's show, you need to really go back out to Monday, Tuesday, and Wednesday and watch it in succession because I think your tutorial experience will be greater watching it in sequence or chronology. I think it's important. Today I want to talk about kind of lump sums. I'm going to touch on a little bit of mortality credits because right now we're all fishing out of the same debenture. Almost all our carriers, we go to the government pool, we're fishing out of whatever bonds they're selling. We're kind of tying it up, we're locking it in. That's our number. We know that's what it is. When we talk about all this week, we're talking about buying lump sums at a steeper discount than anything we're doing in current company practice with any annuity that I'm aware of. I mean, there might be some anomaly here, but I don't know of any too many. So when we're talking about lump sums, there's really a huge issue here for secondary market annuities. Walk me through, let's talk about immediate and deferred income streams that are period certains.
Right, and the one difference we have with the primary market for people who are looking for immediate income, retirement income expenses, necessary expenses, or people who are willing to defer for a while, those other products are guaranteed for life. So you can tell somebody if you live to 122 years old and you beat the oldest guy in India for longevity, that's going to keep paying. Whereas we've got to go period certain. We may be able to get them to 85, 90, wherever they feel comfortable for, but there's a potential for another need on the back end of that. And so we can't just sell them an SMA that's going to cover their income needs for a certain period of time. We've got to consider the fact that they may want longevity and there may be an opportunity for another sale out there.
So you may have to do a tandem sale using the settlement to get you out to whatever it gets you out in a period certain, and then may have a future block like a DIA maybe or whatever out in the future.
And that's one of our current clients who's done that very well. He actually wasn't a client of ours until he purchased SMAs. He went out and bought a bunch of longevity contracts or DIAs that were set to pay when he had 6 or 7 of them laddered, starting to pay one at 80, one at 85, 2 at 90, and he had an incredible amount of deferred retirement income waiting for him when he was 80, 85, 90, but what he needed the 60 to 80 part, and that's what we did. And when you look at his contract or his retirement plan, it'll blow your mind. It's amazing what kind of output he has seen from that, and for what he's going to get over in the future, relatively little investment because he's very efficient about it.
So if I'm hearing you correctly, my secondary market settlement annuities, I could be looking at that period from 60, 65 out to maybe 80, and that's where I'm going to have a wheelhouse issue. I'm going to have a better potential better discount. I might have higher payments, but I'm still going to need some backstop issue into the future because in this market, if I'm hearing you correctly, there are no lifetime income issues, right?
No, absolutely not. They're all period certain. You're buying the income stream from another individual. It was underwritten on them, and we can only buy the period certain portion of that income stream. And so we buy that, which means that it's going to stop at some point in the future. Now, we've got clients. I have a client that is positive he's not going to live past 74. He said, why would I buy guaranteed income? I'm not going to live past 74. Well, we made sure that he had a big lump sum paying at 72, 73, just in case. So he's got a lot of money waiting for him down the road and a lot of money coming to him in the interim. But there are also people who say, my grandma is 106 and she still walks to the grocery store on her own. And so I got a plan for 100 plus. And so your client's going to tell you what they want to do and what's important to them.
Of course, if he thinks he's going down at age 74 and we have some kind of medical advance, that could be a problem. But whatever.
That's why I gave him a lump sum.
That's why I gave him a lump sum. Now, when I'm talking about integrate into our thinking here, how cheap, I mean, when I think about mortality credits right now, they are about as cheap as it gets.
Yeah.
Talk about that in relation to SMAs.
Well, in the mortality credits, we'd really have to look at what kind of payment it produces, and so that's how we run our comparison. So a SPIA may be based in portion on mortality credits, but the SMA is going to be based on effective yield. And so we really got to take the quotes that we get from the companies and see where they fall when we apply our effective rate, our effective yield, or discount rate, whatever you want to call it, to the SMA, and see what kind of payments it produces or what type of investment it requires.
If I'm trying to compare an annuity, because really, in effect, this settlement is not an annuity product per se. I can't take that product and say I'm going to 1035 it to another annuity. It's really not an annuity.
No, it's not.
But it's just functions like that from a carrier point of view. All the carriers that are involved in the settlement market, it looks and functions just like an annuity.
Yeah, and the biggest thing about the annuity and what people really want, the reason they're popular, is because of the guarantee. It's the only product that has that capital G guarantee that is really important to people that are retiring. You don't want to have to redo it, and you don't want to have to go back to work when you're 72 because something didn't pan out. You got to have that baseline guarantee. And a lot of the guys that have been on your show in the past have talked about it, and a lot of big names in the market who have made their careers on preaching that. And here's just another way to do it in this low-rate environment. It gives you an option and a way to really get some work out of your money. And one of the ways I always say it is people have been waiting and sitting on the sidelines and not wanting to lock in a guarantee, and they're looking back 2, 3, 4 years ago saying, oh, I should have done that because I didn't want the risk of the market and the rates are low, and I didn't lock it in because I thought they were just going to shoot up, and everybody's thinking that tomorrow those rates are going through the roof. If you could take your experience over the last 4 or 5 years and say, you know what? I really would like the rates of 2008 in a fixed product. Well, we've got them. They're here. With the discount, we're equivalent to what they were 5, 6 years ago. And so it gives you a chance to do it over again, really. And
Well, we come back from the break. We're going to continue our discussion on using lump sums, mortality credits, and maybe even look at this as kind of a comparison to zero coupon bonds. We'll be right back. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment with Brian Anderson and from Annuity Straight Talk. And Brian, let's talk about how you're comparing this now to some of the household issues like fixed interest rates, like CDs, like zero coupon bonds. Give me a kind of an idea what we're looking at using the settlement secondary annuity market and using them as kind of a alternative to each one of those.
And it's just somebody that's looking for yield. They're looking to park money in a certain place, and you want to. A lot of people, for instance, one of our advisors in St. George, Utah, he's in an area where there are a lot of retirees, and people down there just love CDs. He's selling them as a CD comparison. We're beating CDs at the local bank in St. George. We're probably over 2%. And so, for somebody that doesn't have the same liquidity features, it doesn't have the same penalty features to pull out as a CD. So maybe it's you put half of the money in one of these things and half of it in a CD. It's not an all or nothing game. And if we want to go to fixed annuities, we've got over 5 and 10 years, we've got some B-plus carriers who are leading the market in fixed annuities. Well, we've got AAA carriers that are beating those by 1.25%.
Now, when you hand this to the client, does it show the subordinating carrier underneath it to give comfort and solace?
Absolutely.
So what do they get in their hand? What is
every contract that comes with is they're going to get the original benefits letter that the person who sold it was receiving. It guarantees that MetLife or New York Life has those payments and they can be transferred. And it ends with an acknowledgement from the insurance company saying that the transfer has been completed and the new...
And the contract is with MetLife, Prudential,
Absolutely.
John Hancock, whatever.
Yes.
Yeah, I think that's huge because the paperwork brings this. This is kind of a new area. People want to make sure, hey, is this a legitimate alternative? Yes, it is. Here are the subordinating paperwork from the carriers themselves. And he's really having the benefit of the original settlement holder.
In reality, it's actually kind of nicer than a primary annuity in the fact that you don't get a 40-page book that you don't understand when you buy a contract. You don't have a 30-page application. You got 2 pieces of paper that are really important.
So even the advisor side of this is pretty easy. You're saying that this is not a big application.
No, it's one document to order the deal, to register intent to purchase the deal, and it's one document to close it. Now, there's supporting documents that are a little bit bigger, but really the nuts and bolts of it are you get compliance from the insurance company based on a single acknowledgement letter, which is equivalent to what they were doing with insurance policies and annuities back in the 30s before attorneys got in the mix. And
now, I noticed on one of your listings here, like I'm always a purveyor, especially for pensions, for mid-range investments, to look at zero coupon bonds. You know, how does that work? It looks great. How does it work with an SMA?
It's similar to a zero coupon bond because it is a purchase payment and a set number of years before you get one lump sum out. No interest in the middle. It simply just compounds at whatever rate it is. And so it's very similar to a zero coupon bond. And for people that like to have those, we've got some clients that want to ladder income, and they're actually using lump sums and zero coupon bonds to diversify and provide income for a set number of years. Well, they invest one sum of money and then maybe have another sum paid out in 2026, for instance, and that's going to be his retirement income in 2026. So it's the same as that. The credit quality is very similar. It's highly rated corporate, and the yields are going to beat out zero coupon bonds.
Talk to me a little bit about college planning. I never went through this in my head because usually annuities are pre-59.5, and I got penalty issues and things of this nature. You're seeing people buy settlements for college education and planning.
Absolutely.
That is a crazy and wonderful thought.
A lot of people have done that, and it's been, honestly, they may come in and say, we want to figure out a retirement income plan. And we use a variety of products or strategies to do that. And in looking at those lump sums, to maybe ladder some in to work with inflation or to give yourself future opportunity. And then they'll look at one of the smaller ones and say, well, that one's paying in 16 years. I got the cutest granddaughter in the world. She's 2 right now. I'd kind of like to buy that little deal that's going to blow up into a $50,000 lump sum that comes the day after she graduates from high school. And that's what I'm going to do to buy her a car and spoil her through college and make sure she's got everything she needs.
Wow,
so,
I'd like to meet that grandfather. So, yes.
I wish he was mine.
Talk a little bit about legacy planning in this regard. You're looking at legacy planning for the future for somebody else now. I have money. I have enough what I need for retirement. I have an overflow in my assets. I want to hand that to children and grandchildren inside my liturgy. So how do I work on that?
Well, it's the same sense in that if you look at it and say, I've got X number of assets. It could be a scenario as simple as a guy who's uninsurable or real hard to get insurance, or rates are not great and so his premiums are too high. If you want a good 5.5%, 6% yield, here it is. The difference between that and life insurance is life insurance is going to pay when the insured dies. This is going to pay on a specific date in the future. So whether the insured or the owner of that dies or not, that payment's going to come due, and he knows exactly when it's going to. So it works real well with the trust when he wants to distribute assets over time, and he doesn't necessarily want it to just all happen when he dies. So you can really time it and really work with the legacy planning in a good way.
I'm assuming if I extend the legacy planning theory, it could be for charitable giving as well.
Absolutely, and we've even had guys interested in working these in with foundations, and several advisors in different areas that have done that and said, well, they can't really take risks with their money, and maybe they don't want to throw a whole bunch, but they'll buy the smaller lump sum deals that really pay out well over 15 years or so, and they say, well, that's just a nice, easy deal, and it guarantees that we're going to have money to fund our charitable organization over time. It worked really well.
This is all so interesting, and for a lot of our advisors, very new. That's all the time we have for today's show. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to downtobusiness.ashbrokerage.com and pick up any of our shows on the archives. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you.